Swiggy. Well, the numbers are looking better, especially on the food business. Food delivery, both in terms of revenue and profitability, is positive. In fact, they've actually turned, EBITDA positive on the food business. And on the quick commerce business, that's where the losses continue. But the promise is that a couple of quarters down the line, there will be profitability even there. We have Karan Taurani joining in. So let's get his thoughts on what he made of the numbers and the management commentary. Karan, so what's your takeaway? What's your report card looking like after Q2, Swiggy?
Hi, good morning. So I think the Swiggy numbers were, better, largely in terms of both the food side and the quick commerce side. The gap has kind of stopped increasing in terms of, there's no potential loss of market share further from here on. Food side specifically, I think the good part is profitability. I think second consecutive quarter where they've seen an increase in terms of EBITDA as a percentage of GOV, it's at about 1.6% right now. But the gap is still there. I think, in terms of guidance, the management was confident enough. They really gave very good guidance that, on the food side, they will probably even grow above industry average and possibly try to gain market share because of innovations around Bolt and other things put together. And on profitability side also, they did indicate that the food business will see consistent improvement in terms of profitability because of ad revenue. Quick commerce, I think, is the challenge here because that segment is now very different as compared to what it was a year ago. Increased competitive intensity, what the larger players are going to do in terms of how things are going to pan out, which verticals, which cities, non-metro markets put together is a challenge. So I think those are the monitorables here on. The food business execution remains to be, top-notch as of now.
Karan, hi, good morning. Prashant here. So we have the Swiggy management joining us and make our lives easier. Tell us the 2-3 questions we should ask them, Sri Harsha, that the market really wants to know, or we'll ask them.
So, I think the first question would be, on the food business side. So as they have mentioned that, 18 to 22% is the market growth rate. And somebody they mentioned the call that they will potentially see increase in terms of growth rate, right? So what are the reasons that they're so confident in terms of gain in market share versus Zomato? Because all these years, it's been a very challenging task, to gain market share at the cost of Zomato. In fact, they were lagging and losing market share put together. So that's one very big question. Second thing on the food side, right? I mean, in terms of the overall profitability, today the gap is quite huge, about 220 bips, in terms of EBITDA margin as a percentage of GOV for Swiggy versus Zomato. How do they see how will the gap kind of reduce? Okay, what are the levers for the same? I mean, they obviously did speak about advertising revenue, platform fee, and so on and so forth. But how will the reduction actually happen? Is it only a function of scale? Or is it something different that they are doing, versus Zomato to kind of reduce this gap in terms of EBITDA margins? Third very big question would be around the quick commerce side, right? I mean, they've indicated that they will kind of increase the store size, increase SKUs, increase take rates. The entire plan and strategy is in place. But what are the risks over there? Because quick commerce as a business proposition today is not the same what it was a year ago. There are too many players coming in, there's overcrowding happening. So what are the kind of risks in terms of the strategy not working in their favor? I think these 3 questions are good enough to address this entire concern around the valuation gap for Swiggy versus Zomato. And also in terms of revenue scale, if they're able to execute better versus Zomato, that gap will also kind of come down. But I think net-net, what you're going to see today is that this 50 to 60% gap for Swiggy versus Zomato will persist because of these things, the scale, the valuation multiple, the entire question on profitability.
Okay, just to go back to some of the points, Karan, that you raised, this adjusted EBITDA margin as a percentage of GOV. So I think for the food business, Swiggy is now at 1.6%, right?
Yes.
And you're saying there is a 200 basis points gap with Zomato?
Yes.
200 basis points. Okay. And market share, where does it stand and what is your expectation? I mean, they're talking about catching in and closing in on the number one. But what's your sense? How much are you penciling in? How will the market share move in food delivery?
See, market share movement is going to be tough as a proposition because today also, if you look at the numbers, I mean, you look at it on a Q1Q basis or if you look at it on YY basis, whatever way you want to see it, the scale gap today also for Zomato versus Swiggy is around 20-25% on the food business side, right? And it is not going to be easy to catch up to Zomato because Zomato clearly as an app has got a very strong user experience around, the dine-out proposition. They have a lot of customer traffic primarily who want to explore restaurants. So I think that is a monitorable in terms of how this gap kind of narrows down. Swiggy has got this entire one app proposition of Instamart and Swiggy, Genie, everything put together. But what is the strategy there? Why are they so confident or how are they confident? How do they exactly see market share gain? Because all these years it has not happened. So what's going to change now?
Yeah. And very quickly, Karan, we have other stocks to discuss with you as well. On quick commerce, because that's where the burn continues and that's where the huge fight is, right? Because we all know that Amazon is coming. We've had that conversation with you earlier. While you said that it's not going to sort of throw people out of business, Amazon's entry, the question is going to be on how, and by the way, I was looking at all the notes that Swiggy released yesterday, and they were taking note of the higher competition even earlier when you had to get, the Swiggy One memberships and all that loyalty programs going a couple of quarters back. On quick commerce, what is your expectation in terms of profitability? When do they turn profitable? And anything that you picked up from the call yesterday?
The quick commerce side, I think there's still very low visibility in terms of profitability. They have only mentioned as of now that around FY27, which is Q3 FY26, at a console level, they will probably be at break even. So they have still not mentioned in terms of, they obviously mentioned the margin for quick commerce on a steady state will be 5% over the long term. But there's no proper visibility in terms of when the quick commerce business will be at break even. As I'm telling you again, the same thing, that because they are not market leaders, because they haven't, kind of pulled on these engines of ad revenue, higher take rate, AOV, SKU, larger store size, what Blinkit is doing very well right now, it's going to take time, because today the market is very different in terms of number of players, in terms of competitive intensity and everything put together. So I think that is going to be a monitorable strategically how the quick commerce turnaround happens. In my opinion, it's going to take some time. It's not going to be very easy for them right now.
Okay, all right. Hi, Karan. Good morning and good to see you. I think we've gone on for a goodish bit on Swiggy and Zomato. Let's talk about PVR. Pushpa 2, can it fire up the stock?
Yes, I think definitely, Pushpa 2 is going to be great respite for the exhibitors. If you look at the month of October and November, October was kind of below par. As per our checks, the occupancy levels were, below 20%. November was good because of Diwali releases, and December is going to be blockbuster. I think in terms of opening day, we are penciling in that the overall opening collections will be anywhere between 125 to 150 crores if you look at the net box office numbers. And on a lifetime basis, this film could reach about 800 to 900 crores in terms of net box office revenue. The records today is of Bahubali 2, which is 1,000 crores net box office across languages. If the word of mouth of this film is good, eventually, you will see those records also being broken, in the month of December. And I think December month that way, because of Pushpa, because of Mufasa, which is like a large Hollywood release as well, which is coming, you could see occupancy levels of, more than 40%. So much needed respite for exhibitors. This quarter, we could end up being at pre-COVID occupancy levels, which could see better margins as well.
And by pre-COVID occupancy levels, just give us a number. What are we looking at here?
So basically, if you look at the cinema, I think it's first half, I think their occupancy levels are somewhere in the range of 24 to 25% on average. I think Q3 will be around between 30 to 31% in terms of occupancy. So Q1Q basis, box office revenues will see a growth of 30-35%.
Karan, ITC, do you have any thoughts after all those GEOM proposals? And but of course, these are all just proposals. They'll have to be, the decision has to be made. But your thoughts?
ITC we don't cover. I don't cover ITC.
All right. We'll leave it then. Thank you very much for your perspective on those questions, and we'll put them to the Swiggy management at 9:40. Thank you very much. So that's the conversation with Karan Taurani this morning on a couple of names, Swiggy and PVR specifically.